My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to a West Coast Cramerica takeover. Other people want to make friends. Me, I'm out here in California to help you make some money. It's my job. It's not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Is tech in trouble? Have the stocks gotten too expensive? Do we need to worry about what might happen to the group if President Trump can't find common ground with President Xi of China and the tariffs get jacked up in December, which is certainly now the thought? With the market at such lofty levels, even after a day where the Dow dipped 102 points, S&P backslid 0.06%, the Nasdaq gained 0.24%, it's something a lot of money managers are talking about. Today, Bank of America Merrill put it out pretty succinctly in a cleverly titled piece called Changes, about how to reposition for 2020, and the big takeaway was that it is time to lighten up on my favorite group, which is technology. Their thesis: the analysts were worried about the trade war shifting to a tech war after the election. Chinese companies only buying from Chinese suppliers, American companies only buying from non-Chinese suppliers. Plus, you've also got the strong dollar to worry about. And with tech rallying lately, you've got a crowd of weak-handed shareholders who head for the hills at the first sign of trouble. So are they right? Now, we can't dismiss this argument out of hand. We've heard some genuinely discouraging things from major players in technology here. I mean, look, just last week, Cisco, it gave a downbeat forecast for precisely the reasons that Bank of America Merrill cited. Even though I think the stock represents good value here, good dividend, good balance sheet, some okay growth, investors have soured on it, especially some of the big guys, because CEO Chuck Robbins and CFO Kelly Kramer actually told a pretty grim story about the future. However, I think it would be a big mistake to give up on the whole tech sector here, and I'm going to tell you why. First and most importantly, there's no tech in tech. All right, what do I mean by that? Listen to me. When I got into this business decades ago, there wasn't much tech at all. You had some semiconductor companies, some defense contractors, IBM, and 5 of their competitors known as Bunch, Burroughs, Univac, NCR, Control Data, and Honeywell. This was back when the mainframe was still king. Big iron, we called it. By the mid-'80s, birth of personal computer, explosion of information technology companies, and their enablers, all worth owning. Then in the 90s, we got the internet boom, and that's when things started to change. Suddenly, tech stocks weren't necessarily in the tech business, something that's only become more pronounced over time. These days, the whole idea of the tech sector itself, I find it misleading. For instance, we have Square on tonight. That's a payment processing play that helps make millions of small businesses competitive with larger ones. Is that tech? We had Levi's on last night. They designed new tech to make more personalized jeans without a lot of despoilage of the world and using a lot less water. Hey, that sounds like tech to me. Shopify? It makes it possible for small operators to sell things on the web. Retail or tech? What about something like Twitter? Or how about video games? I mean, that technology is chock full with the most sophisticated chips we have. But is that a media business or tech? How about the hardware that powers them? Is tech still tech if it's in the garage, if it's in the living room, the kitchen, the bedroom? Most important, where do we categorize the software as a service place? Like ServiceNow, which just was added to the S&P 500 and vaulted big. Or Adobe, which went from being a digital publishing play to an e-commerce juggernaut. Or, yes, the company that is the reason why we're out here, Salesforce.com. I mean, Salesforce.com practically invented the industry with its customer relations management software platform. I don't know if we would have called that tech a few years ago. You've got billions and billions and billions of dollars of software sales that I don't think can be contained by the rubric tech. Certainly not the ones that you're supposed to sell because Bank of America Merrill says lighten up. When I think about that piece, when I think about the things they're worried about, they may apply to hardware, specialized hardware, but they don't have much to do with the software as a service space. Something like Salesforce isn't really driven by international trade. It's driven by its own indispensability, the word I want you to think about. Indispensability to other businesses that need to digitize or die. Indispensability is the driving force, not miniaturization, but making it so that you can compute and trade in a way that makes it so that you can stay alive as a business. Sure, their stocks will get hit if President Trump tweets something like, yes, quote, I am sick and tired of my good friend President Xi, and I am taking Chinese tariffs up 30% in 2 weeks because he won't even buy pork to keep his people fed, end quote. Hey, you know what? That actually sounds like a tweet that he'd make, the real Donald Trump. In fact, these stocks will probably be the first to go down again because the algorithms that we're so ruled by sell them on any trade worries. But after that, their stocks tend to come bouncing back with alacrity because these companies are forces of nature. All right, let me put these tech worries in perspective. This morning, Kohl's, KSS, a department store chain that mistakenly my charitable trust had, well, not a big position, but owned a position in, reported what I regard as a massively disappointing quarter. Although to listen to management, you'd think that they had some sort of blowout. They were congratulating themselves. It was a head scratcher, which is something I advise you not to do if you have as much spray-painted makeup on or you'll get a lot of dirt on your fingernails. I think Kohl's is in an existential crisis, frankly. It's going full Jean-Paul Sartre. You don't pronounce CRE. We're in a period of monumental turmoil for retail where the only real survivors will be the companies that dominate in the off-price space or the ones that dominate online. Kohl's? KSS? Kiss me, stupid? It does neither. It has to find a way to either become the lowest cost seller, which I don't think it has the ability to do, or it has to spend fortunes to develop a digital strategy that's good enough to compete with Walmart or Target or Amazon. And I don't think they need to. After listening to today's call, I don't think it's possible. Because management seems to be in total denial about how much it needs to spend on tech before it can even get in the game. They think they're doing great. Hey, when you're doing great and you're not, well, that's how your stock that's how it goes down 20% like it did today. But the lesson here is simple. If you want to stay competitive in retail, you need to pay these software as a service companies a fortune. Yeah, you got to write them big checks. That's why I rebel against this idea that you need to lighten up on tech because it's because there's too many people who own it. I mean, it's a club too crowded. I mean, come on. The tariffs will hurt. No, indispensability. How about the biggest companies on earth, Microsoft and Apple? Worry about those? Microsoft remains omnipresent, but they've done such a good job of diversifying away from the plain old PC business that I can't imagine their numbers being hurt that much by China. It's Azure is really the king there. That's right, their cloud business. Apple, trade will always be an issue with Apple because they can't afford to turn their backs on roughly 1.5 billion people in China. But Apple has managed to thread the needle during the trade war because they've created millions upon millions of jobs in both countries, and it has the confidence of both leaders. In short, they may just be able to transcend the whole conflict. Wow, hats off to Tim Cook. Oh, let's not forget the rest of FANG. There's Facebook, Alphabet, Amazon, Netflix. These companies have no Chinese exposure to speak of. And when you ain't got nothing, you got nothing to lose. Thank you, Bob Dylan, at least in earnings per share. So here's the bottom line. If you feel compelled to sell tech, ask yourself what you're selling. If you're dumping an ETF, be my guest. Those are just moronic amalgams of stocks slapped together by people who make a living by convincing you that the tech sector is a real cohesive thing. But if you're dumping the kind of tech stocks that are working here, especially the better-run software as a service names, I think you make a big mistake, and one that you'll regret when this trade war eventually blows over, and it will. Wes in North Carolina. Wes.
Hi, Jim. Love what you do.
Thank you.
My stock is Snap, and the stock's up 9% recently and on top of some fairly decent gains. What are your near-term versus long-term thoughts?
Okay, I think that Snap is what I regard as got a scarcity problem. There's just not enough Snaps out there. You need to be able to reach that demographic. They've got that demographic, talking from speaking younger people, and that's why I think that the franchise is worth a lot. Wish they didn't have so many different classes of stock. I wish that they didn't have a class of stock that made it so you can't take it over, because, boy, they sure should be. All right, don't give up on the whole of tech here. If you're compelled to sell, ask yourself, what are you selling? But please don't dump the kind of tech that's working out here in San Francisco that we've been profiling for you. On Mad Money tonight from CNBC One Market. Warren Buffett is betting on Restoration Hardware. Should you do the same? I'm sitting down with the CEO of the luxury furniture retailer. Then Salesforce has grown Dreamforce from 1,300 attendees in 2003 to more than 170,000 in a pilgrimage to San Francisco. What tech trends can be uncovered from the cloud's biggest conference? I've got the exclusive with co-CEO Mark Benioff. And then with NVIDIA declining a tad today. Is it prime time to buy? You know how I feel. Well, let's talk to the CEO to find out. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.